Hello everyone, welcome to Business Education and Research. This video presents about the non-performing assets of commercial banks. We can discuss about the classification of non-performing assets and the impact of non-performing assets on the stability and growth of commercial banks. The classification of non-performing assets are typically based on the duration of default and the likelihood of recovery. The main classifications include standard assets, loans where the borrower is making timely repayment of interest and principal as per the agreed terms. For example, a mortgage where the borrower consistently pays the monthly installments on time. Substandard assets, loans where the possibility of full recovery is uncertain, but they have not yet become doubtful. For example, a business loan where borrower's financial condition deteriorates, affecting repayment capacity. Doubtful assets, loans with a high probability of non-repayment, but specific losses cannot be ascertained. For example, a loan to a company facing bankruptcy proceedings where recovery is uncertain. Loss assets. Loss assets are category of non-performing assets where the bank has identified that the loan is irrecoverable and such little value that their continuance as a bankable assets is not warranted. These assets have been written off by the bank as a loss on its book. For example, a bank has extended a loan to a small business that subsequently declares bankruptcy and liquidated its assets. After exhausting all legal avenues for recovery and determining that there is no remaining assets to seize, the bank identifies the loan as a loss asset and writes off the outstanding balance. Now we will discuss about the impact of NPAs on stability and growth of commercial banks. To start with, let us see how NPA affects financial condition of the bank. Financial health deterioration. NPAs erode profitability and capital adequacy, hampering banks' ability to lend. For example, a bank reports decline in profits due to increased provisioning for bad loans. Credit risk accumulation. Accumulation of NPAs raises credit risk exposure, undermining depositor and investor confidence. For example, investors sell off shares of bank after learning about its rising NPA level. Regulatory scrutiny and penalties. High NPAs attract regulatory attention, leading to penalties and operational restrictions. For example, a bank faces regulatory fines for non-compliance with NPA recognition norms. NPA results in reduced lending capacity. Constrained capital availability. NPAs tie up bank capital, limiting funds available for lending. The bank reduces its loan disbursement due to capital tie-up in bad loans. Risk-averse lending practices. Banks adopt cautious lending strategies, reducing credit flow to the economy. A commercial bank experiences decline in loan portfolio growth due to restricted lending capacity caused by high NPAs. The bank tightened its lending criteria, rejecting loan applications from high-risk borrowers. NPA leads to erosion of profitability. Increased provisioning expenses. Banks allocate more funds for provisioning against potential NPA losses, impacting profitability. Banks' profit decline as it sets aside a higher percentage of earnings for loan losses provisions. Net interest income decline. NPAs lead to decreased interest income as increased interest expenditure affecting net interest income. Banks' net interest income falls due to lower interest earnings on loans and higher interest paid on deposits. Commercial banks' net profit margin shrinks due to increased provisioning for NPAs and reduced net interest income. NPA affects the reputation of the bank. Loss of investor confidence. High NPA damages bank's reputation, leading to loss of investor trust. Shareholders sell off their holdings in a bank due to concerns about the asset's quality. Customer attrition. Dissatisfied customers may switch to other banks with better assets quality, leading to loss of market share. Deposit holders withdraw funds from banks with high NPAs and transfer them to a more stable institution. Banks' market value declines as customers and investors lose confidence in its ability to manage NPAs effectively. NPA results in liquidity constraints. Illiquidity in assets conversion. NPAs are often illiquid, making it challenging for banks to convert them into cash, meet short-term obligations. Bank struggles to sell off foreclosed properties to meet its liquidity requirements, raising cost of funds. Banks may resort to expensive borrowing to meet liquidity needs, further impacting profitability. Bank raises funds through high interest interbank borrowing due to lack of liquid assets. Bank faces a liquidity crunch during financial crisis, leading to difficulties in meeting deposits withdrawal demands. NPA impact on economy. Slowdown in investment. Reduced lending due to NPA hampers investment in productive sectors, leading to economic slowdown. Businesses delay expansion plans due to difficulty in accessing credit from banks with high NPAs. Unemployment rise. Lack of credit availability affects business expansion, leading to layoff and unemployment. A manufacturing company downsizes its workforce due to decreased production caused by lack of funds from banks. A country's GDP growth rate reduces as businesses face funding shortages resulting from a credit crunch caused by NPAs. NPAs leads to regulatory constraints. Capital adequacy norms. Regulators enforce stringent capital adequacy norms on banks with high NPA levels, limiting their expansion. A bank is restricted from opening new branches due to regulatory concern about its capital adequacy ratio. Prompt corrective action. Regulators may impose PCA on banks with severe assets quality issues, restricting their operations. Bank faces restrictions on dividend distribution and branch expansion as part of PCA measures. Banks' growth prospects are constrained by regulatory restrictions imposed due to its high NPA levels. NPA impact on market perception, stock price volatility. High NPA levels lead to volatility in bank stock prices, reflecting market perception of its financial health. Bank stock experiences sharp fluctuations in value following news reports about its rising NPA level. Investors' confidence impact. Market participants adjust their investment decisions based on a bank's NPA levels, affecting its market value. Institutional investors reduce their holdings in bank stocks due to concerns about its quality of assets and profitability. Banks' market capitalization declines as investors sell off shares, fearing the impact of rising NPAs on its future earnings. NPA impact on interest rates. Higher borrowing cost. Banks with high NPAs may increase interest rates on loans to compensate for potential losses, making borrowing more expensive. A small business faces high interest rates on its loan renewal due to bank elevated NPA levels. Credit rationing. Banks may ration credit or tighten lending criteria to mitigate risk, reducing access to affordable financial for borrowers. For example, a first-time homebuyer struggles to secure a mortgage as bank becomes more selective in their lending practices. Rising interest rates and reduced credit availability hamper consumer spending and investment, dampening economic growth. NPA impact on capital adequacy. Capital erosion. High NPAs deplete banks' capital reserve, potentially leading to breaches in regulatory capital adequacy ratios. For example, a bank's Tier 1 capital ratio falls below the minimum threshold due to surge in NPAs. Need for capital infusion. Banks may need to raise additional capital to offset losses from NPAs and meet regulatory requirements. For example, a bank issues new shares to investors to bolster its capital base and improve its capital adequacy position. A bank faces pressure due to strengthen its capital position to absorb potential losses from NPAs and maintain regulatory compliance. NPA impact on loan loss provisioning. Increased provisions. Banks set aside more funds for loan loss provisions to cover potential losses from NPAs, reducing profitability. For example, a bank allocates higher percentage of its earnings to provisions as it anticipates higher defaults on its loan portfolio. Impact on reserve. High provisioning for NPAs reduces a bank's retained earnings and available reserve for future investments or dividends. Banks' retained earnings decline as it diverts profits towards building provisions for expected loan losses. For example, a bank's profitability is dampened by elevated provisioning for NPAs, limiting its ability to reinvest profits or distribute dividends. Impact of NPA on legal and recovery costs. Litigation expenses. Banks may incur legal expenses in pursuing debt recovery from defaulting borrowers through legal channels. For example, a bank engaged law firms to initiate foreclosure proceedings against defaulting mortgage holders. Assets valuation cost. Banks may incur cost in assessing and valuing collateral and held against defaulted loans for potential assets recovery. Bank hire independent appraisers to evaluate the market value of foreclosed properties held as collateral. For example, a bank's profitability is further impacted by legal and recovery costs associated with pursuing defaulting borrowers and realizing assets valuation from NPAs. NPA leads to loss of competitiveness, market share erosion. Banks with high NPAs may lose customers to competitors with healthier balance sheets and more attractive lending terms. For example, a bank experiences a decline in deposits and loan volumes as customers switch to rival banks with their lower NPA levels. Reduced borrower confidence. Prospective borrowers may avoid banks with high NPAs, fearing stricter lending terms or loan rejection. For example, a business seeks financing from alternative sources like non-banking financial institutions due to concerns about bank's assets quality. A bank's competitive position is weakened as it lost market share and borrower confidence due to elevated NPAs and associated risk.